now being joined by the Group Managing Director, AfroInvest West Africa, Mr. Ike Chijioke, to look at the banking sector. Thank you very much for joining us, Mr. Chijioke. Glad to see you.
Good morning.
Is it proper for me to say Happy New Year? I mean, I'm seeing you for the first time since the new year.
I think this is the first time I've come here physically, so I'm glad
and
that the vaccines are coming around, so it's good
it's
to
great
be
to
able
have
to come
you
out
here
directly.
physically. All right, now we're looking at the financial services sector, specifically the banking sector. Now, that sector reported growth of minus 3.63%. That's in the fourth quarter of 2020, and that was sharply lower than the ICT sector. Yet the banks are still announcing some kind of stellar profits, you know, in their earnings report. What has been the major driver of this?
What we've seen is that the banks have actually been very focused in two areas. Reducing their cost of funds and also expanding more into the retail sector. So in terms of cost of funds, you know, remember that at a point last year, prior to middle of last year, banks had to pay a minimum of 30% of MPR on savings deposits. And with that level, then that sort of affected what else you pay to other kind of deposits in the bank. They got the CBN to allow them to pay only 10% of MPR. With MPR at 11%, 11.5%, that means they can only pay 1.15% on your deposit base. That reduction has actually created opportunity for banks. You see a bank like GT Bank, you know, having reduced its cost of funds from 2.1% on average in 2019 to 1.2% in 2020. That's quite a significant amount of savings, and that all trickles to the bottom line. On the other side, they've also expanded risk assets. And you've seen a bank like UBA grow risk assets by 24%. That has then resulted in, you know, interest income growth of 5.4% on its balance sheet. So those twin factors of reducing cost of funds and expansion in retail risk assets has also helped. We saw the banking sector grow overall for the year about 13%. So notwithstanding the contraction, which was pandemic-induced, overall for the year, they actually grew, you know, positively.
Okay, so banks and telcos had a strategic tussle recently regarding the USSD charge.
Okay.
And they actually finally agreed on 6 naira 95 kobo per transaction. Do you think that this resolution of this terminating charge will further compress the margins of banks, you know, at a time of dwindling revenues and higher costs?
You know, what you saw there was, you know, telcos have always billed the banks on a corporate basis, so for all the USSD charges that customers are incurring. But it was a blended cost previously. It used to be 4 naira 89 kobo, with the banks picking up part of the cost. And because it was a corporate billing, I think we saw the telcos, you know, becoming a bit more careless and trying to lump more costs on the banks. So the bone of contention was to agree on what would be the fixed maximum charge, which is now 6 naira, I think 98 kobo, and it will be billed directly. So even though it's going to be billed to the banks, they will pay on a wholesale basis, but the amount will be exact, and they will transfer those charges direct to the customers and charge their bank accounts, not their airtime. But now that you've seen an increase in USSD charges, we anticipate there could be some reduction in those kind of transaction flows for banks, because these are customers at a very sensitive cost level. And so, but altogether, that has been somewhat resolved, and there's more clarity in those charges. And banks do not have to pay the actual extra 20% or pick up the 20% of the cost they used to.
So it's still the customers that will bear.
It's now the customers that will bear.
So it's not going to have any impact on the bank, banks themselves?
No, actually it's been positive for them.
Okay. Yeah. Now, Fitch and S&P, of course, fear that Nigerian banks risk assets, which are currently 30% in foreign currency denominated assets, pose a major risk of an asset liability mismatch, which could make them not only vulnerable to a squeeze in cross-border liability calls, but also could make them exposed to any adjustment in the value of the naira in the forex markets. Therefore, the twin exposure and, of course, liquidity crunch could create a problem for Nigerian banks from, you know, foreign regulators. And I know that AfroInvest usually, I mean, you publish Nigerian banking annual reports. Looking at this report from Fitch and S&P, are you surprised, or do you agree that these risks are now elevated?
They may look elevated on the surface, but I think, you work in an industry where once beaten, twice shy. And for many banks, having gone through the recent recession of 2016, they are not about to make the same mistakes. Many banks have learned to only advance foreign currency loans to companies or individuals or businesses that have foreign currency income to match. So there's always a matching. If your business does not generate foreign currency, they won't try to create any risk assets around it. It will be very, very isolated. So notwithstanding that 30% exposure of their risk assets to foreign currency, currencies, we don't see that the risks are elevated. On the contrary, what you also find is that in an environment of high inflation and high risk of devaluation, banks have also seen a large increase in foreign currency deposits. So they're actually struggling to balance the liabilities against the assets. And the intention is to keep on having a net positive position where there are more assets against the foreign currency liabilities. Because, the average Nigerian may well think, if I'm at risk of having, what was maybe 306,000 naira back last year, beginning of last year, if you use the CBN rate, was equivalent to $1,000. Today, if you use the CBN spot rate, official spot rate of 379, you have to bring 379,000 naira. I see what that has happened. Plus, you add inflation, like you mentioned, at 17%, that further eroding the value of naira. So quite a few Nigerians have begun to keep their deposits in Nigeria in dollars. So the banks are seeing swelling exposures in liabilities in dollar positions in their system. Likes of Zenith Bank, GT Bank, even FCMB have a net positive position. So they have to keep on trying to find risk assets so long as they can match those assets to companies that have income in dollars. As it turns out, the oil price has begun to trend upwards, currently at around $64. So that's even positive because quite a lot of those risk assets are going to the oil and gas sector.
But can we really depend on the oil market or the oil price considering the volatility?
Yeah,
well, that's true. But remember, when the oil prices declined steeply in 2020, that was because of the massive lockdown effect. Global supply chain systems are completely disrupted. Businesses shut down. Some livelihoods were completely eradicated. Now, with the vaccine rollout going on with good momentum, and you can then see that some economies are reopening. Nigeria is, we are reopening quite well. I'm here physically, so you can see things are happening. So I drove my car. Yeah. So all that consumption is, fueling, the support in the oil price. And of course, OPEC Plus have been very disciplined in trying to, curtail production levels so that it makes sure that this oil price trajectory continues to be in the positive direction.
All right, looking at the risks here, what risk mitigants would you recommend at this point?
I think you can always say that you need to keep on diversifying your loan portfolio and not try and concentrate it all in one area. I mean, oil and gas sector is still disproportionately taking a large chunk of the risk asset creation in the banks at 25%. Compared to contributing only about 10% of the GDP of the economy. But what banks are doing now is also looking at the retail sector. But it's difficult. Again, it's always a balancing act when you have a contractionary economy. We just suffered a 1.9% economic contraction in 2020. Yes, we've come out now. There's positive momentum with the 0.11% growth in GDP in Q4 2020, but that's still not quite enough. So diversification is important, but the key thing is really focusing down on each individual risk asset and to be sure you understand inherent risks in there.
Yeah. Now, recently, the central bank reported a slight increase of about 0.1% in the non-performing loan levels of Nigerian banks to about 6.1%, but quickly reassured the investing public that Nigerian banks are safe and sound. And then we noticed that the central bank, was remarkably silent about the capital adequacy ratio of the industry, especially after withstanding this recession. So the question is now, should we really be raising some kind of eyebrow there?
No, I think I agree with the central bank's position. This 6.1%, is a 0.1% increase. Yes, at 6% of non-performing loans is above the industry average, the regulatory threshold of 5%. But we are not at the 12.9% height of 2016. What has happened is that in 2020, CBN was much more, I would say, aggressive and forward-thinking in coming with a basket of monetary measures. And there are also some fiscal palliatives that were introduced. All of that had kind of cushioned the negative impact of COVID-19 on the economy, to the effect that the banks, who are actually the first ones to feel the effect, have been able to sort of withstand the impact a bit more. And we can see with the oil price trajectory, there's more capacity even to support those fiscal and monetary policy measures they've introduced, those stimulus package. And that's why we see coming out of this now, having just gone up 0.1% above the 6% they were at, we don't expect really any more difficulty. We expect that we are really on the path of recovery going forward. Yeah.
Okay, the bankers have complained that the frequent CRR debit has been impacting on their ability to plan and also increase lending. And some also believe this is another move to curtail demand for FX. What's your view on that?
Well, if you think about it, today with the MPC just having released their results last week, maintaining liquidity ratio at 27.5%. So for any bank, the starting point is got 27.5% of deposits are neutralized. Then you have loan-to-deposit ratio at 65%. Though that's another bunch of cash neutralized. So you see that the average bank, they only have 7.5% to play with if they are trying to look at sort of opportunities they can play with in the market. But having said that, though, the frequency and timing of the CRR debits could certainly be, you could construe that to be CBN's direct effort to make sure they don't have cash at the time when they're supposed to be bidding for dollars, because, you have to always back it with cash each time. So, yes, we do suspect there's a ploy by CBN to do that. And of course, CBN is also in a difficult position. You have high inflation, you have FX liquidity, you have low interest rate environment in the country. So it's really trying to balance a whole bunch of things, And I don't think that monetary policy measures are sufficient. I do think that at this point we really need to be looking at broader fiscal policy measures and also things that affect the wider society, to calm the polity down to the point that you can get that investor confidence back. But in terms of the bank's view, yes, I agree with you that it will seem like a subtle ploy by CBN to make sure they don't have enough liquidity each time there's an FX auction, so that there's not too much naira chasing dollars, especially in a market where there's, dollar illiquidity. Yeah.
All right, a quick one before we let you go, Mr. Chijioke. I'm sure you're preparing your banking sector report for this year. When should we expect it, and what should we be looking at?
No, we would have to go further in, because the banks are just announcing earnings, so we need to get all the earnings season's results in. So we can't really start publishing until we're sort of right in the middle of the year. And at that point, we'd also have a sense of where the economy is going and be able to sort of, look closely at our crystal ball to see whether we're on track.
All right. Thank you very much, Mr. Chijioke. It's always a pleasure talking to you.
You're most welcome. Thank you very much indeed.
Ike Chijioke is the Group Managing Director, Afri Invest West Africa.